Nearly 4,000 years ago, in a city that no longer exists, a man named Nanny pressed a reed stylus into wet clay. He was writing a complaint. A merchant named Ayan Asir had sold him the wrong grade of copper, refused a refund, and sent his servant home through a war zone, empty-handed. That clay tablet survived. It sits in the British Museum right now, and it is officially the oldest customer complaint in recorded history. But here's what most people miss about that tablet. It wasn't just a complaint. It was a financial document, a transaction, a dispute, a broken contract, and an expectation of accountability. 4,000 years ago, the same structure you'd find in any court filing today. Around the same time, another tablet from the same region recorded a silver loan from a merchant named Eden Marduk. Interest, 20% a year. Repayment due in 3 months. Witnesses listed. Term sealed in clay. 3,700 years later, your bank offers you a loan. The currency is different. The medium is different. But the structure is identical. One party gives money. Another pays for using it. A third guarantees the deal. We live in a world of instant payments, digital currencies, and financial products so complicated that the people selling them can barely explain how they work. And yet underneath all of it, underneath every fortune made and every fortune lost, sit 5 rules that haven't moved in 4,000 years. The Babylonians knew them, the Romans knew them, medieval bankers knew them, and every person who ever lost everything from ancient Ur to Wall Street ignored at least one. 5 rules, 4,000 years of evidence. None of them will surprise you, but I guarantee you are breaking at least one of them right now. Babylon, around 1700 BC. An ancient parable gives us a character called Arkad, a scribe, carving tablets for other people's contracts. He earned the same wage as every other scribe in the city, but he did one thing differently. Out of every 10 coins he earned, he set one aside. Not after paying his bills. Before. Not a tenth of what was left. A tenth of what came in. The difference sounds trivial. It is not. This wasn't invented by modern finance gurus. Babylonian clay tablets, the oldest financial records on Earth, show the same principle nearly 4,000 years ago. If money is sitting in your account, you'll find a way to spend it. Everyone does. The only thing that works is taking your share before you see the rest. Here's a number that says it all. The average person saves about 4 or 5% of what they make. People who built their wealth from scratch, no inheritance, no lottery, save 15 to 20%. They don't earn more. They just take their share first and figure out the rest after. Part of everything you earn is yours to keep. Take it before the world takes the rest. That was true in Babylon. It's true now. It will be true long after we're gone. Now, if rule number 1 sounds simple, even obvious, rule number 2 has destroyed more lives than any war in history. Rome. The year is 33 AD. Emperor Tiberius revives an old law requiring creditors to invest a portion of their capital in Italian farmland. Sounds reasonable, but the consequences are catastrophic. To buy land, creditors need cash. To get cash, they start calling in loans, well, all at once. Debtors can't pay. They try to sell assets, but everyone is selling at the same time. Prices collapse. Credit freezes. The economy spirals. Tiberius is forced to open the imperial treasury and hand out massive, interest-free loans to stop the bleeding. The first government bailout in recorded history, nearly 2,000 years before the same thing happened on Wall Street. Now compare that to 2008. Banks had lent too much money to too many people who couldn't pay it back. When the loans started failing, everyone panicked at the same time. Banks tried to sell assets, prices crashed, lending froze. Governments had to step in with hundreds of billions. Same chain reaction, same panic, 2,000 years apart. In ancient Rome, if you couldn't pay your debts, you could literally become a slave. Today, the punishment is different. Bankruptcy, losing your home, a credit score that follows you for years. But the feeling, the fear of owing more than you can pay, That hasn't changed in 4,000 years. Debt itself isn't the problem. Roman builders borrowed money to construct aqueducts and roads that lasted centuries. That's debt that creates something. The problem is debt that buys things that lose value. One swipe, one vacation, 12 months of interest, a car that's worth less. The moment you drive it off the lot, a lifestyle funded by money you haven't earned yet. There's a simple test. If the thing you borrowed for makes you money, it might be worth the risk. If it doesn't, you've just made a promise to your future self that your future self might not be able to keep. A loan that doesn't pay for itself isn't a tool. It's a trap that springs later. The Romans learned this. We learned it in 2008, and we'll learn it again. But even if you save and avoid bad debt, there's a third mistake that can wipe you out in a single day. Venice, 13th century, the richest trading city in the Mediterranean. Venetian merchants controlled routes stretching from Constantinople to Alexandria, and everything they had depended on ships. But every ship could sink. Every cargo could be lost to storms, pirates, or war. So, Venetian merchants made a simple decision. Never put all your money on one ship. They spread their bets at different ships, different routes, different goods. If one ship went down, the others kept you alive. They even created the first partnerships, where several merchants would share the risk of a single voyage. Simple idea, life-changing consequence. This idea grew into something bigger, insurance. If 10 merchants each put a small amount into a shared fund, and one of them lost a ship, the fund covered the loss. No single family was destroyed. Lloyd's of London, still one of the biggest insurance markets in the world, started exactly this way. A coffee house, ship owners, shared risk. An ancient Jewish text, the Talmud, written about 1,500 years ago, gave even simpler advice. Put a third of your money in land, a third in business, and keep a third in reserve. That's it. Any financial advisor today would tell you basically the same thing. And every time this rule gets ignored, the result is the same. In 1637, the Dutch, some of the smartest traders in Europe, put everything into one asset, Tulip bulbs. When the price collapsed, entire families were wiped out overnight. .com, 2008, Crypto 22, every crash in living memory destroyed the people who were all in on one thing, every single one. The man who puts everything on one ship drowns with it. That was true in Venice. It's true now. So you save. You avoid bad debt. You spread your bets. Surely you're safe. Not quite. Because there's a force that can shrink your money while it sits perfectly still. And most people don't even notice it happening. Rome again. 3rd century. This is the story of how an empire quietly robbed its own people, using their own money. It started small. Emperor Nero took the silver coin everyone used and quietly mixed in a little cheap metal. The coin looked the same, felt the same, but it had less silver inside. Nobody noticed. The next emperor did the same, and the next. Over 200 years, a coin that used to be almost pure silver became almost worthless. Prices exploded. One emperor tried price controls, making it illegal to charge too much. Merchants just stopped selling. You can't force people to trade at a loss. Here's how it works. And it's the same trick every time. A government needs more money than it has. It can't raise taxes. People would revolt. So instead, it creates more money out of thin air. More money chasing the same amount of stuff means everything gets more expensive. Your paycheck buys less. Your savings shrink. And the people who own land, houses, and businesses, their stuff goes up in price. They get richer, you get poorer. Same trick. Every country. Thousands of years. Inflation is not a storm. Nobody is a victim of bad weather here. It's the result of deficits and printing. And it always moves money in the same direction. Away from people who save cash, toward people who own things. Think about it this way. $1 in 1913 could buy what $30 buys today. That's not the dollar getting stronger, that's the dollar melting, slowly, invisibly, year after year. And the people who kept their savings in cash, they lost almost everything. The people who turned their cash into land, houses, businesses, gold, they're fine. If your money isn't growing, it's dying. Because someone right now is printing more of it. 4 rules down. Save first. Avoid destructive debt. Spread your risk. Protect against inflation. But the 5th rule, and the last one, is the one that catches the smartest people in the room. Back to Babylon. Arkad, the same scribe from the first rule, makes his first investing mistake. He gives his savings to a friend, a bricklayer, who claims to know the gemstone trade in Phoenicia. The bricklayer is excellent at laying bricks. He knows nothing about gemstones. The money is gone. The lesson was recorded on a clay tablet. Do not entrust your money to someone unskilled in managing it. 4,000 years old, still ignored daily. Fast forward to 1720. London. The South Sea Company promises extraordinary returns from trade with South America. Isaac Newton, the man who figured out gravity and ran the Royal Mint, buys shares, sells early, makes a nice profit. But the price keeps rising. He watches. He can't help himself. He buys back in at the top. The bubble pops. Newton loses 20,000 pounds. Several million in today's money. His famous quote. I can calculate the motion of heavenly bodies, but not the madness of people. 2008. Big banks on Wall Street created complicated financial products. Basically, bundles of thousands of home loans repackaged and sold as investments. The products had fancy names and high ratings, but almost nobody, not the people selling them, not the people buying them, not even the agencies grading them, actually understood what was inside. When people started missing their mortgage payments, the whole thing fell apart. The global economy nearly collapsed. Not because of bad luck, because the smartest people in the room were trading things they couldn't explain to their own kids. The pattern never changes. A Babylonian gives his savings to a friend who doesn't know what he's doing. Newton puts his money into a company he doesn't understand. A retirement fund buys a product nobody can describe in plain language. 4,000 years. Same mistake, different clothes. If you can't explain how an investment works in 60 seconds, you're not an investor, you're a passenger, and someone else is deciding where you're going. 5 rules, 4,000 years of evidence, and not one of them is new. Pay yourself first. Babylon, 1700 BC. Debt destroys faster than income builds. Rome, 33 AD. Diversify or die. Venice, 1300 AD, and the Talmud centuries before that. Inflation is a tax nobody voted for. Rome, 3rd century. Never invest in what you don't understand. Babylon, Newton, 2008. Why don't these rules ever change? Because they're not really about money. They're about us, about how people think, how people feel, how people make decisions when they're scared or greedy or tired or excited. Greed hasn't changed in 4,000 years. Fear hasn't changed. The urge to spend more than you have hasn't changed. The dream of getting rich overnight hasn't changed. And the habit of ignoring tomorrow because today feels urgent, that hasn't changed either. The tools change. Clay tablets, silver coins, paper bills, apps on your phone, crypto. But the rules by which people lose and keep their money, those haven't moved an inch. The most expensive mistakes in financial history aren't technical, they're emotional. Impatience, pride, following the crowd, and they repeat, because we do. 4,000 years ago, a Babylonian scribe scratched an interest rate into wet clay. That tablet is in a museum now, but the rules he lived by are not. They're right here, in every decision you make with money. Are you paying yourself first, or hoping something's left at the end of the month? Is your debt building something real, or just pushing the pain forward? Would you be okay if one of your investments went to zero tomorrow? Are your savings growing faster than prices, or quietly disappearing? And can you explain every place your money is in plain language? Or are you just going along for the ride? The rules aren't new. You already know them. The only question is, how many are you breaking right now? If this made you rethink something, subscribe. I break down these patterns every week, and tell me in the comments, which of the 5 rules have you broken, and what did it cost you? The most honest answers I'll pin to the top. I'll see you in the next one.